All right, we are now live with the live stream for the FOMC meeting tonight. In about 10 minutes, Jerome Powell is going to mention if there's going to be rate cuts, if he's going to be holding them at the same basis points as now. So here's the prediction. So let's see what the odds are. This is usually a pretty good representation of what's actually going to happen. So we have the odds here in front of us. As you can see, 25 basis points, 93.8%. So yeah, basically what everybody has calculated on is 25 basis points. So it's kind of priced in already. Usually these probabilities are quite accurate. There's also an option for 50 basis points. That's 6.2%. So it's a small chance, but I saw that actually those odds have been increasing the last days. So yeah, there's still some either way, but mostly the magic happens in the speeches from Powell. So let's see if he's hawkish or dovish today. So we're just gonna wait first, see the rate cuts. So that's in 10 minutes. So we'll see the amount of basis points, and then 30 minutes later, there will be, of course, Powell's conversation. So I will show it live, and I will give you my commentary on it. If there's any questions in the chat, you can just drop them here, and I will go over some exposed in between, and I will show some charts as well. Let's see what the charts are doing, of course. So let's get into it. What's up, Romeo? Let's go. Curious what would be the outcome you're saying. Yeah, the outcome, good chance, 25 basis points, which is, it's been a long time since we had a rate cut. So it's a good thing, but it's been kind of priced in already. So before I go to the charts, let's go over some expos. Let's see what people are saying. First, we have some traders here. This is a pretty famous one. He's actually bearish at the moment, which is quite interesting. He has been, mostly bullish, and he's been quite accurate this year and the past years. So people, take notice of his opinion. That's why I included it in here. He's short, so yeah, it's already priced in. But that's also what we know. But it doesn't, in my opinion, it doesn't mean too much. Then we have another mega whale. This guy is actually crazy rich. Shows his trades live. So I wanted to include this one here. So he's thinking we're actually going up, but mostly Bitcoin. So he's just his plan is Bitcoin grinding up 150K by the end of the year. So that's quite a push still. But alts, what they're doing since the year basically lagging a little bit. But still, yeah, if Bitcoin goes to 150K, there will be some good alt pumps. You can bet on it, even if you don't have the particular alt. So yeah, that would be a good scenario. So his plan here is on Bitcoin dominance. Here you see the chart he posted. So he thinks we're kind of bottomed here. So his idea is not a dump of the full market, but basically just a pump of dominance. Then there's quite some betting. This one, the past record, 200 million in volume today, making it the largest FOMC prediction market. So you can bet on Polymarket. Let's actually go to Polymarket and see what odds are. Yeah, it's pretty much the same as FedWatch. What I already showed you. 93%, 25, 50 basis points, 6%. So yeah, if you want to bet on this, then it means you're making a lot of money. So there's the probability that it's 25 is quite high. But as you can see here, let me see. 60 BPS. No, that's been quite similar. Let me see if it has some changes. It increased a little bit. You had 4.5%, so it has been increasing a little bit, but that's not that much to be honest. So it's a pretty clear view of what's going to happen here. Then market prediction from Ash Crypto Real. Yeah, it's already priced in. He thinks there will be a dump. Continuing dump. And then, yeah, he's calling for a Q4 150K Bitcoin plus. And I think a lot of people are actually predicting the scenario that, the Q4 is going to be the one. A lot of people are positions for altcoins in Q1. That will be a good scenario, but if we get multiple rate cuts, that will certainly help. Happy FOMC day. Let's begin trading. That's often not a good idea. A lot of people like to trade it, and there's a lot of degens trading it. But the chance you're getting liquidated is quite high because they usually take out both the longs and the shorts. So if the real move is going to be bearish, then it often means that they're first going to take out the shorts, and then they're going to dump it, and same with the other way around. So we have 4 minutes to go until the rate cuts are decided. But yeah, that's it's not that spectacular. We're going to be waiting, and we're going to be streaming until 2030. So that's 30 minutes later, and then Powell is going to do his speech. So that will be quite interesting. Here we see 11 billion in stables that floating to exchanges before our FOMC meeting. Big money knows something. So you can see here in the chart that's actually quite a spike in the last days. So this could be potentially some insiders because 11 billion. Yeah, that has to move the chart big time. MintLab says here he's correct, but yeah, you never know what that money actually is going to be doing there. Could also be here what he says could not be simply the case. Exchanges themselves preparing liquidity in case everybody sells. There's lots of opportunities, but for sure there's moves being played. Yeah, there's a lot of people. This is a famous betting. You can bet on this pretty much every time. I think somebody bet like 50K on this, while the odds were even better. And he did it live. So it was quite interesting to see. Yeah, 89%. That's not something I really want to bet on. You're either going to make no money or you're going to lose your money, basically. But still, it's quite funny. You can bet on everything nowadays. No major liquidity clusters in terms of liquidity. Here we got Jerome Powell. Of course, he and Trump have been going at it. Trump is not happy with him. Trump's want him fired. And it appears he doesn't really give a fuck. FOMC will be sell the news. Interesting. Included his opinion here because he's actually some quite good calls. All right, so in a minute, we're going to hear about the actual rate cut or not. So the easiest thing would be let's just tune into to Mario's and see what the rate cuts is, and then after we're going to do some charts. All right, it's not here yet. Let's see. Here we have Powell getting ready. Here we have a big better here on 50 BPS bait cut. User King 8 is either destined for history. All right, we have it here. Breaking Rose says Federal Reserve cuts interest rates by 25 basis points. So that's what has been expected. Let's see how the chart responds to this. Let's call Bitcoin here. So this is what everybody expected, which has been kind of priced in. Let's go to the 1 minute chart. We see some liquidations, but still 15 and 16K. So this is not really a big move yet. So we're quite stable so far, but it's also been priced in. Now it's the waiting game until Powell is going to speak. So I'll also be showcasing some altcoins soon, but first let's see if Bitcoin is going to make any moves here. Some wicks to 15.6, and seems we're quite stable so far. So what I did actually like is that we've kind of dumped into, you cannot really call it a dump, but slow grind down into FOMC, as you can see here, some profit taking, which is it's better than you don't really want to be seeing big bumps into FOMC because then it's usually the other way around. Same thing with altcoins. This is almost actually always the case. I took notice of this, quite a while. That altcoins usually dump into FOMC, and then they pump again afterwards. So it's kind of what has been happening here. Of course, we had a big pump, so we had a normal retracement. But oftentimes it's a lot harder. So you see people selling their altcoins because they're scared, and then they're buying in again. Oftentimes it's really like a local low area. Ethereum, nothing special yet. Well, I was seeing a decent candle here after the 25 BPS was announced. If you guys have any requests for altcoins, you can also drop them in the chat. Then I will chart them for you. Any of your favorite altcoins, just drop them, and I will take a look at this as well. We have about 25 minutes till Powell is going to speak. Powell is going to speak. Yeah, not so much movement. Let's go over some altcoins. All right, we got some movement here for Algorand. Let's see if it's altcoins in particular. All right, we have a decent bounce now for some altcoins. It doesn't mean a lot yet. When Powell is going to speak, yeah, things can turn around quite quickly. But so far, market seems to like it. Let's see what dominance is doing. Yeah, that's what I thought. Altcoins gaining some traction. Of course, people are scared going into FOMC for the in case, yeah, the horror scenario is that there's no rate cuts when they've been priced in. So that's why there's always some people taking their money out. That's probably what you're seeing right now. ICP, we got some long-term accumulation here. This is one that could surprise. Then we have Tau. I like this chart here. It looks quite good. You have some solid support this area. My guess is we're going to work our way upwards here to 470, and then eventually get to those highs again. This one has been going nuts lately. Meme coin, meme core, it's called. It has some crazy, fully diluted valuation. I think this one, this continues to go. This should be a good short, but for now, yeah, we're following a clear upward trend here. As you can see, this is bounce here at the right time. So in this scenario, we're probably going to touch the upward band again. But yeah, what I saw this, I looked into the utility and valuation, also the fully diluted valuation. So when there's going to be tokens in circulation, I think it's 2.5 bill or something right now. And I think it's over 20 bill fully diluted. So that's a lot of money. Look at those X's. It almost looks like it doesn't really happen in crypto anymore, but there are a few examples like Mix and this one. Imagine buying, getting in here, 14 cents. This is the Binance one. I think it's been. Let me see. I think I have the other one. Oh yeah, here 0.05. Yeah, that's a lot of X's. So my thoughts on this one are probably hitting the upper band here, and then it's. I think it's going to be. It will probably be a great short area. These kind of patterns, when they top out and you start to fall out, you probably start to roll over a little bit here, and then yeah, this should dump quite hard at a certain point. Now there's some hype with pump.fun, of course, so that's why it's quite yeah, some similar utilities. You can launch memes on there as well. It's on the BNB chain. Look at this one, guys. This one was $9. $9. This pump made no sense. It was yeah, it was absolutely nuts. I remember I actually had a short up here, but I closed it. I closed it somewhere here. I didn't. Yeah. Uh, look at this. Imagine you have a short open here, and you wake up and you see this. That's crazy. It's over 90% in valuation. And you imagine you have a short here. But people buying this up here, then I don't know what to say. It was, I think, like 8 billion valuation, even more. Yeah, yeah. Then you deserve to. Then you deserve it. I have no other words. I think it had like 6 million of TVL, and it's absolutely not that they were able to get this up so far. But yeah, it was the ideal short. I had a short open, but was unable to keep it open. And yeah, I do actually think the team is still building. They announced a big buyback program as well. I think like 40 million or something they reserved for it. So that's quite some numbers. So I expected actually some kind of bounce already earlier, but yeah, that didn't quite happen. We had one bounce here, but to 39. After that, it's been flatlined again. But at some point, this probably will get a real bounce. So then you look at 60 cents, maybe even above $1 again. Yeah, it's a lot of liquidity up there. Let's see what else we have. Let's see what Bitcoin is doing now. Yeah, it's not much movement yet. We had first a shakeout, and then we had 25 BPS announcement, quite a pump, and we're just hovering around. This is not much special. People are waiting for Powell to open his mouth, and let's see what he has to say again. Is it going to be hawkish or dovish? People like to see a continuation of the rate cuts that we get now. Dogecoin has been doing well lately. It's just one of the bigger caps that has been lagging a little bit. Most big caps have actually been doing quite good. Started, of course, with XRP and Solana, then Ethereum, and you see also BNB, and now Dogecoin starting to do well. Had a breakout here of this long-term pattern. So this looks quite good for continuation, in my opinion. Could go a little bit lower or not. Probably this is yeah. This looks like a good area. If the market turns bullish again, this is probably the area where you want to get in. Actually, so if you get an upwards move, then we should aim for the highs here. Highs from December and January. Then some lower caps. Lower caps actually have been having a really hard time lately. All these AI coins like PAL, GPU have been rough. So the money actually has been flowing into the bigger caps, but smaller caps have been having quite a hard time yet. But at the same time, it does play kind of in hand the playbook of an alt season where the lower caps come in later. So yeah, there's going to be select lower caps that are going to do good numbers. But this is really the time where, yeah, I said that before. It's not going to be anymore like 2017 or 2021. There's just way more tokens now on the market, and there's way more dilution. So that means all these tokens, these big tokens that have launched with VC money, some of them launch with 10% or mostly it's between 10 to 20% on TG. Means the rest of all these tokens are continuously going onto the market. So it's really hard to keep all these coins uh, at yeah, decent valuations, and even for some extreme altcoin season, you want yeah, there needs to be a lot of money to flow into the market. So I think that's something that really has changed. It's going to be select narratives of altcoins, and usually the one that have yeah, good market making as well. So they do not have a lot of selling pressure, where the market maker has a lot of control in regards to yeah, token control. All right, 15 minutes to go before Paul was speaking. Okay, we had that initial pump. Now we're seeing, but we're retracing it back down. So we started here, and that's where you can see you have the initial dump, and then these people that shorted here and after stop loss, they got taken out here. And yeah, these are the games that are being played. This is why it's so dangerous to trade these FOMCs because they're taking out both sides, and it's waiting for the real move. That's always the thing. Yeah, same thing on other tokens. Bitcoin getting hit a little bit harder, even it seems, than regular altcoins, which is interesting. All right, let's check the X feed. All right, I see some requests. Let's chart some coins. Romeo says Fed. Let's take Fed. Let's zoom out. I don't think I have this one charted. Let's reset these drawings. These are quite old. All right, let's see. First, I always like to do the high time frame. And then, of course, we have the support here. You see kind of an upward sloping trend line like this. Yeah, this seems like a accumulation pattern here. Looks quite stable here. You see this area is quite strong support. Take the box here. You can see this is the area that you want to keep holding. This is, I would say, this is the main support box. Yeah, you want to be keeping trading into this triangle and eventually burst out of it. And then we could go for the highs for sure. Let's see near. Oh yeah, this one I have charted. I like this one. This is a good chart because we have clear support here. And this support coincides also with the upwards going trend. So you can easily see if we're yeah maintaining a good structure here. So you want to stay above this area. If you're starting to get down here, 170s, 180s, yeah, that doesn't look good. But as long as you remain here, the 220, um, we should be good to touch the highs again. Oh, that's already quite a move up to here. Once we break out here, then it's yeah, it's pretty certain you're at least going to test this level. So that's already 750. You're probably going to yeah. This is what I think. Let me get the drawing there. Where's the brush? So you get up there, you reject, then you break through. You reject here, you get a retest like a flush, and then you have the momentum enough to start going for that 17. But this would be yeah, if you get a real alt season scenario. All right, and then we have yeah, let's see Ondo. Ondo is a good one. Very strong fundamentals, which in this difficult market the last years is what you want to be looking at. You don't want to take too much risk at the same time. Yeah, there should also be upwards momentum, and this one, yeah, looks quite good. You see here, you got this broadening wedge, and very often what happens is it's going to get another one up here. But it happens very much. So here we broke out again. We had the retest, and you would say, yeah, you're going again, but that didn't quite happen yet. Doesn't mean it's not going to happen. As you can see, this area is starting to be quite some resistance. So I said that in the last stream. Actually, you want to yeah, break out to that 120 area. You start to close here, then you should be good to go, and then you should be good to go to higher levels. The next level is here, about 140. But in my opinion, yeah, there's no reason you should not go to $2. And for altcoin season, if we get it, yeah, target is about $4. So for a strong fundamental coin, a 4x is quite good. IMX, yeah, gaming token. Let's see. I think it dumped quite a lot. Let me check. I got it here already. I didn't chart it yet. So let's see. First, we're taking upper support here. Then we're taking the lows. Can also put a box there. Yeah, here's your liquidity area. So what market makers do, they have the like the market makers, they work with certain areas where they're buying, like the big players. So they're always buying at these long term order blocks. You can see here, you hit a nice double bottom. So they, if they want to buy, they actually push it down all the way here. And this is, you can see, this was an area of interest. And oftentimes, these double bottoms are really important. If you start to bounce here, you get out of there. Yeah, these are really good areas you want to be buying. You see this a lot, these double bottoms. Same with double tops. It's a very powerful pattern. And now you're seeing, good to look at these EMAs as well, because they're quite important. And now it has worked on the daily through all these EMAs. So you got strong momentum upwards here. Now it's going to be trading under there. So my thought is we're probably going to hit this area. It's almost a 2x. And then you probably get a little bit more consolidation. You need some more strength to really push through that, some consolidation, and then yeah, you get through there. Once you break out such a long consolidation, I would say you're gonna retest the highs again. That's very likely. All right, we got 7 minutes to go before Powell is speaking. Let's check my feed. Let's search FOMC. Let's see what people are posting. Okay, this guy made a whole analysis. So he thinks inflation data going to be hot, which has been lately. Yeah, he said 25 BPS. That was what happened, of course. So initial reaction, 25 BPS fully priced in, which is certainly the case if you have such a high percentage. What will then matter is a dot plot and exact wording of the FOMC statement. Yeah, that's what people are waiting for Powell to say in good evening. So that's what we're waiting for in 5 minutes. Key here will be Powell indicates this is the beginning of a recalibration cycle, very bullish. Yeah. So it's really you have to look at these what he's saying. You have to look at the way he's saying certain things. He's not going to be overtly, yeah, hawkish or dovish. You really have to uh, find it in between the words, and the market is always doing that really good. So you're seeing exactly what he means if he's starting to make some statements. So let's search FOMC. Let's see if we have some more interesting analysis here. Yeah, so there's a narrow majority of officials, at least a total of more rate cuts, which would be a good thing. Statement changes are dovish. God bless my money printer. Yeah, Trump has been quite heavy on him. Trump has been saying he should have been cutting way earlier, but it seems he's finally starting now. Income charge, he's a big one. Let's see what he says. Here's your FMC map 2 days ago. Study the price action. Interesting. So he thinks rally will most likely be a blow off top local area. So dump on FOMC. Here we have the reporters. All right, let's switch. We're 3 minutes in, so we have to let's start the live stream. All right, 1 minute to go before you're speaking. Let's refresh it. And now we're starting. see, have a last look at the market.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the market slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, this inflation appears to be continuing for services. Great, of course. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 0.25 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risk to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country.
He's not that happy with
everything we do
inflation.
is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
All right, now the questions. Oftentimes, this is where
thank you, Chris Rugaber,
he starts to
as you know, Fed Governor Stephen Myron has continued kept his position at the White House even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
You and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
It's certainly possible. We're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. Typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timrose of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
Market slightly down since it's been talking, but not really big
over
moves
the course of this year, we've kept our policy at a restrictive level. And people have different
You could
views,
see
but
in
a
his
clearly restricted level, I would
talk
say.
about inflation that it's
So
not
we were able to
too
do that
happy yet
over
with
the
the
course of this
rise
year
in
because the labor market was
inflation
in
the
very
last weeks.
solid condition, strong job creation and all that. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to those at a time when we feel that policy is a place and needs to move quickly to place. That's not at all wait and see.
Yeah, he's been very reluctant to cut lately. So it makes sense that 50 basis points was not on the table this time. All right, let me reload it. The broadcast is
Cuts in the last 5 years, and you tend to those at a time when we feel that policy is a place and needs to move quickly to place. That's not at all wait and see.
Kind of in place. I guess I'm just trying to square the shift in the rate forecast in the SEP.
it's lagging a little bit here. Let me see. It's just I think it's the general connection on the website here.
Towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Let's see what the market is doing. Not too much big moves. I think, everything what he's saying so far has been quite calculated.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP,
all right, we're kind of restarting here. Let me open a new tab.
In place. I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth next actually ticked up just as you look.
All right, doesn't seem it wants to work with me. I'm curious if I'm the only one. It's my connection or it's just the website. Let's check here. Let's check Mario. Let's see the last question.
The risks of higher and more persistent inflation have probably become. And
all right, so here we have the full broadcast again.
That the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low, still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand which is now perhaps more than that in supply. And we know that because the unemployment rate has ticked up. So, that's what I meant by that.
A follow-up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Yeah, the 2% seems quite far away.
Thanks so much, Elizabeth with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that though, right? We have to. Our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass through of the tariffs into inflation has been slower and smaller. The labor market has softened, so the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates.
I still saw a little bounce on that comment there.
For a long time, our framework says that when our two goals are in tension, and this is quite an unusual situation, how do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal.
Interesting.
So,
Dr. Provitt is still bearish here.
As I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
What concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
We got the crypto rovers.
It's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Or are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the
I think he was hinting at there's a good chance that there will be
a sign of
less cuts
uncertainty of
than
policy
predicted.
in the meetings to come? Thank you.
It is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low, and when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have
people are saying it's quite hawkish,
and that means there's no risk-free path. And so it's quite a difficult.
It was known though
that
inflation has been going up lately, but it's been repeating it.
A range of views. It's not so much about having different views for the path of the economy, but it's partly that, but it's also partly about what's the right thing to do.
Benjamin Cowell was predicting for a while now that we're seeing
how do you weight them,
dominance go up again. So he's thinking, we get a push for
it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based on, in this kind of highly unusual situation, and we do. So, but we get together, we discuss. We have a great discussion, and then we decide what to do, and we act. But you're right.
Dominance is not really moving yet.
It's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about
so far it's a bit hawkish
over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do.
There's a lot more shorts than
the incoming data
than longs at the moment, which is quite interesting. This was before the speech.
Never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of does it help or hurt this political party, this politician. That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to serve the American people as best we can. So I think you would be able to tell. I don't believe we'll get to that place
this year.
I would say we're doing our work exactly as we always have now, and people they're making their arguments, and we're having really a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you called it in the past, noisy.
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. It's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second, certainly the third month. So it's not that we don't get the data; it's just that we get it a little later.
For the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut rate?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. And we took that appropriate action today.
Thanks, Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. The black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I hadn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter, and I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all this together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed towards
somebody bet on 50 BPS.
Earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, its spending. So I mean, I think the economy is it's moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So labor market unemployment is low, but downside risks, but it's still low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
Of course, I'm not going to comment on
That's an
anything the
interesting
Secretary
question.
says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve system and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
Not an independent review?
We're certainly open to always trying to do better.
Yeah, that would be a great thing. There's a lot of voices who are actually calling towards ending the Fed. People like Elon Musk and Ron Paul. So there's a lot of criticism in regards to the Fed itself as an institution, but that's something that will play out for the longer term.
Is already starting to affect the labor market in terms of lower labor demand, high productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other.
Yeah, AI is something that will be driving unemployment in the coming years. It's going to be a lot of job takeovers, so it's going to be interesting to see how they're going to be responding to that as a society in whole.
Institutions that have been hiring younger people right out of college are able to use AI that more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down, and so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high. But we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4 or something like that to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass through has been pretty small. It's been slower and smaller than we thought. But the evidence it's very clear that there's some pass through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret some of his speeches, for example, and then some of the forecast that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret what you guys are saying?
So there's 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the plots are really so scattered between someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you had about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember though, the unemployment rate's 4.3%. The economy is growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times, but from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment. Those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you, Archie.
All right, seems to have been a bounce.
You mentioned
here.
earlier that job creation is running below your guess at its break-even rate. I'd be curious to hear a bit more about that, where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly. And that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Well, if I may, you mentioned that.
Yeah, with the speed of development in AI, it's likely going to continue. The question is just how fast.
Downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PC numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand, lower borrowing rates for
All right.
builders.
I think most of it has been said by now, so it's not too happy with the rise in inflation. Of course, everybody knew that already. Not too problematic yet. Labor market is weakening. In my opinion, this will continue. Like I think AI is going to play a big role. The question is just how fast it's going to be. And we had Garrett Soloway already warning here. Interesting, he's quite bearish here for stagflation, which is something that could happen, but it looks like that's something for next year. So it's not on the short term. Market reacting, no big moves yet, nothing too crazy is being said. Of course, the 25 basis points has been predicted. No major moves. Yes, he's been staying a little bit in the middle. So I think we've seen most of it. Now let's see what the market reacts coming days. I think for me, I'm just holding my tokens. I think we're in for a good run. The chart looks good for later this year, so I'm not too worried about the short term here. Right, this was it for the stream. Was the first live stream. Give it a subscribe and like to support the channel, and I will be doing more of these live streams. Can also charge your favorite altcoins as well, and of course there will be more videos coming. Right, that's it for today. I'm ending this stream.